Meet Mike, who is within 10 years of retirement, and Graham, who is already retired. They are both active investors in the stock market, but prefer to focus on trading large and mid-cap stocks over the medium to longer term, not day trading. I can empathize with them because after over 30 years of trading, that is exactly how I go about trading the stock market. Returns are great, with hardly any time requirement. My personal investing mission is to outperform the total return and accumulation indices by 5% annualized, with just 15 minutes a week of investing effort, meaning that over the long term, I aim to get 15% annualized returns from the stock market. Over the decades, it is abundantly clear that such great returns with so little ongoing real-time effort is impossible to achieve without a mechanical edge. So what is a mechanical edge? It is an algorithm with precisely defined, unambiguous criteria that tell me exactly when to buy and when to sell any given stock, managed as a portfolio of stocks. I spend no time analyzing or reading anything to decide what or when to buy or sell, ever. The more scientific name for an edge is mathematical expectation or expectancy. I also call it a statistical edge or probabilistic edge. The edge is called mechanical because its decision criteria have no emotion, no second thoughts, subjectivity, hesitation, or doubt about when to signal a buy or a sell for any given stock's price. Humans suffer all these decision-making problems, and I've got rid of them all. Hi there, my name is Gary Stone, founder of Sharewell Systems back in 1995. The mentioned algorithm discussed on this channel is unique to Sharewell Systems. You can follow how well this proprietary algorithm works through the many videos we publish, showing and telling transparent stories about my real money live traded portfolios. We'll pull apart all there is to know about trading with this distinctive buy-sell decision-making mechanism, including why it is so important to have an objective algorithm, how it was created, how we've refined it, and most importantly, how best to use it to achieve consistency and objectivity to grow your wealth in the stock market. Who are the investors we help and have helped since 1998 when I finally went mechanical? Let's go back to Mike and Graham. On their respective journeys aiming to consistently outperform the way the bulk of their money used to be invested by third parties, both constantly encountered road bumps, roadblocks, and detours that slow down their growth and enthusiasm for investing. Detours like selling stocks too late or not at all, resulting in large losing positions. Or road bumps like being overweight in cash when the market is soaring, thereby stifling returns. Or road blocks like getting back into the market very late after a serious retracement and missing out on juicy early trend profits. Or having large positions in losers and small positions in winners, which also stunts growth. Both worked out years ago that trying to grow their wealth via mutual funds and other third parties like financial advisors would only give them average to poor long-term financial growth, well below the goals they had set, while they paid away massive fees that should have been contributing to compounding their own wealth, not somebody else's. As a result, both had come to the realization to actively invest in the stock market to achieve what so many before them have done, to grow their wealth by achieving better returns than the market indices, and hence better than nearly all mutual funds and financial advisors. After a few years of trying different approaches, they are still on that journey to achieve this. Both have summed up the approaches they used in the past as, firstly, ever-changing analysis criteria to decide what and when to buy and sell, that is, subjectivity. Secondly, thorough but incomplete company research. And thirdly, allowing analysis and research to be overruled by news cycles, which are not part of their decision-making process. They've also said all the approaches they have tried are time-consuming, which reduces the time they'd love to be spending doing other things with other people. It is not difficult to safely overcome all of Mike's and Graham's problems, their decision overruling, time, analysis, and subjectivity problems, and improve their returns with just 15 minutes a week to monitor, measure, and manage any size stock portfolio from $25,000 to $5 million, with a few weeks training depending on how quickly they want to learn. What we talk about on this YouTube channel is built on 30 plus years of trading experience and well over 5,000 hours of rigorous research on how stock prices move, resulting in a medium-term stock system that has a robust edge. Trading the stock market with a system that we transparently discuss and show on this channel enables you to efficiently outperform the stock market indices with far less drawdown than those same indices over the long term. The system enables simple stock selection, timing, position sizing that is precise, and robust risk management. The system's ease of alerting when to sell via an app enables you to catch all the really bad trades early without hesitation and doubt. Timing is everything, but you must have an unambiguous buy-sell algorithm to time the market and stocks successfully. To learn the necessary knowledge and skills to do this, peruse the playlists and subscribe to this YouTube channel to be notified of new videos being published.